Welcome back to Smart Stock Sam, the channel where institutional-grade analysis meets the retail investor's playbook. Today, we are diving deep into a NIO that just delivered the kind of earnings beat that most analysts said was flat-out impossible. We're talking about a setup so loaded with catalysts, a historic profitability milestone, an aggressive short squeeze building in the background, and a rock-solid trade target sitting right at $7. And we are not just talking about short-term price noise here. We are talking about a structural inflection point, the moment when a company graduates from promising but unprofitable to growing and genuinely making money. So if you've ever wondered whether NIO has what it takes to become a genuinely profitable EV powerhouse, stick with me, because what I'm about to show you will fundamentally change the way you look at this company going forward. But to see where we're going, we first have to look at how we got here. Let's start with the week that changed everything. In just 5 trading sessions, NIO delivered a staggering plus 21% weekly gain, not driven by a rumor, not driven by a meme, driven by something far more powerful, a milestone that critics swore would never arrive on this timeline, NIO's first ever Q1 GAAP net profit. Now, for those of you who aren't accounting nerds, here's why that matters. GAAP stands for Generally Accepted Accounting Principles. It is the gold standard of financial reporting. No creative adjustments, no one-time exceptions, no loopholes. When a company books a GAAP profit, it means they are genuinely, structurally making money. And here's the jaw-dropping part. NIO is currently the only Chinese EV peer to hit this milestone this quarter. Every single one of their competitors is still bleeding cash, and NIO just walked across the finish line first. With heavy institutional buying already in motion and a short squeeze tightening its grip, we are now targeting a price of $7. This is the story you need to understand before next week opens. Now, it's one thing to make a prediction, but it's another thing entirely to watch the market execute it with surgical precision. Back on March 9th, we laid out a detailed forecast on this channel, and the accuracy is almost scary. We reported an operating profit between $102 million and $175 million. The actual non-GAAP adjusted profit came in at $178.9 million. We called for a post-earnings push toward $5.50, and the stock surged to $5.70 before closing the week at $5.86. We even flagged the internal unicorn investment from Genetec, which we reported at $330 million, and it was confirmed at a definitive $322 million cash injection. But the number that should make every trader in this audience sit up straight is this. We identified the entry zone between $4.70 and $4.78, and on March 9th, the stock hit a precise low of $4.74, the perfect entry. If you caught that window, you're already sitting on significant gains. But the technical chart tells us there is still a tremendous amount of gas in the tank. Let's look at how the price action actually unfolded this past week. After tagging that $4.74 entry on Monday, Tuesday's earnings beat served as the ignition switch, immediately triggering our initial $5.50 target and pushing intraday highs to $5.70. There was mid-week consolidation, which is completely normal and healthy after a move like that. But the stock never buckled. It held structure and closed Friday, March 13th, at $5.86, a full plus 21% gain in 5 trading days. Price action this clean, on volume this heavy, tells you that this move was not retail-driven noise. It was institutional rotation. But why is this happening right now, when so many other EV players are stalling out? The answer is structural profitability, and it's hiding in plain sight. For years, bears hammered NIO with the same argument. Too much spending, not enough results, burn rate unsustainable. Well, that narrative just got buried. NIO reported a GAAP net profit of $40,400,000, or 282.7 million Chinese yuan. Look around the EV landscape right now, their Chinese peers are still underwater. Every single one of them is burning cash while NIO has crossed into the green. This is not a quarterly fluke. This is a sign that the business model has reached the kind of scale where it becomes self-sustaining, and once that engine turns over, it is extraordinarily hard to stop. If you think the profit numbers are impressive, wait until you hear what management just guided for next quarter. Their Q1 delivery guidance calls for between 80,000 and 83,000 vehicles. That is a year-over-year growth rate of 90% to 97%. Think about that for a second. In a market where everyone is talking about slowing EV demand and brutal price wars, NIO is nearly doubling its output. The transition into a healthy, high-growth, self-sustaining business cycle is not a future promise anymore. It is the new reality. But what is the secret sauce that lets them grow this fast while everyone else is struggling? It all comes down to infrastructure, and NIO's infrastructure is a genuine competitive moat that rivals simply cannot replicate overnight. They now have 3,815 active battery swap stations deployed across their network, and they just crossed 100 million total battery swaps completed. Here's why this matters beyond just the headline number. It creates behavioral lock-in. Once a customer experiences a 3-minute battery swap versus a 40-minute charging session, they are emotionally and practically locked into the NIO ecosystem for life. That level of customer retention is priceless, and it's a wall that no newcomer can scale quickly. And it's exactly this kind of long-term infrastructure advantage that has smart money moving in with massive size. The institutions are no longer sitting on the sidelines. Quadrature Capital Ltd. just initiated a brand new position worth $58,310,000. HSBC Holdings increased their active stake by nearly 49% this month alone and simultaneously issued a buy upgrade with a price target of $6.80. But the headline number that should genuinely surprise you is UBS. They executed an unprecedented 4,000% increase in their position. 4,000%. When you see institutional accumulation at this scale converging at the same time, it almost always means the big players are pricing in something the general market hasn't caught up to yet. But even with all this buying, the stock still had to navigate some serious macro turbulence this week. On March 12th, the market absorbed the news that US GDP growth had been revised down to just 0.7%. For most high-growth stocks, that kind of macro shock triggers a sharp sell-off. But NIO held its critical $5.50 psychological floor on heavy volume. Institutions weren't selling into the fear, they were absorbing it. They were buying every share that nervous retail traders were throwing away. That set up Friday's catalyst perfectly. The HSBC upgrade pushed the stock up another 5.59%, closing the week at $5.86. That is resilient price action. That is exactly what you want to see before a breakout attempt at a key level. And that key level brings us to one of the most interesting technical setups playing out right now, what I call the liquidity trap. Sitting right above us is the $6 psychological barrier. It's acting as a ceiling. But here's where it gets fascinating. There are currently 147.19 million shares sold short. As the price mechanically approaches that $6 level, those short sellers face a forced covering event. And with only 2.28 days to cover, this trap becomes a fuel source. Every short seller who capitulates becomes rocket fuel for a squeeze, pushing directly toward our $7 target. Does this mean it's guaranteed? No. But the setup is about as loaded as it gets. While the shorts are sweating, the options market is making an even louder statement. Current options flow is sitting at an overwhelming 82.82% bullish. We are seeing heavy call buying across multiple strikes, but one specific trade stands out as highly unusual, a block of 1,207 contracts placed specifically on the $7 strike, expiring April 2nd. That is not a casual retail bet. Somebody with a serious amount of capital is making a very deliberate, very directional wager that NIO hits $7 within the next few weeks. When you align that options positioning with the institutional accumulation we just covered, the picture becomes very hard to ignore. So if you're looking to play this move, here is your exact map for the week ahead. Our current price is $5.86. Below us, key support sits at $5.50, the open interest floor, with the 200-day moving average providing a deeper floor at $5.24. Your ideal dip buying zone is the $5.84 Fibonacci pivot point. That is the level to watch for aggressive entries on any pullback. To the upside, our first resistance is $6, which doubles as the short squeeze trigger. Clear that, and the next stop is $6.50, aligning with the Macquarie price target before a final push toward our $7 target. Based on everything we've covered, I am giving NIO a strong buy rating across all daily and weekly timeframes. Your entry strategy: look for positions between $5.75 and $5.86, and consider adding on dips toward that $5.84 pivot. Conservative target: $6.25, aligning with the recent Nomura upgrade. Aggressive target: $7 flat, aligned with the Morgan Stanley price target and that April 2nd options cluster. But we aren't just trading charts here. There are major fundamental catalysts ahead that could decouple NIO from the rest of the market entirely. This coming week, March 18th and 19th, we have the Federal Reserve meeting. Yes, the broader market will react. There will be volatility and noise. But given NIO's distinct fundamental profile and its positioning as a China-based company with its own macro drivers, I believe it remains relatively insulated from whatever the Fed signals. The real micro-catalyst on my radar is April 9th, the ES9 launch. This vehicle features NIO's proprietary 5-nanometer chips and state-of-the-art steer-by-wire technology. That is not a spec sheet flex. That is the kind of hardware leap that drives pre-order momentum and forces analyst upgrades. And that brings us to what all of this is actually worth. Even after the historic 21% breakout this past week, the current price action barely scratches the surface of NIO's true fundamental value. While the street is focused on the $7 squeeze potential, our fundamentally modeled intrinsic fair value for NIO is $18.27. Based on current profitability trajectory and forward growth, the stock is undervalued by nearly 200% at current prices. The $7 trade is not the end of this story. It is just the opening chapter. Before we wrap up, I want to be transparent with you. Nothing in this video constitutes financial advice. Smart stock. Sam produces this content for educational and informational purposes only. All investments carry risk, including the potential loss of principal. Always do your own research. Consult a licensed financial advisor before making any investment decisions, and never invest more than you can afford to lose. Past accuracy does not guarantee future results. Now here's the question I want to leave you with, and I want you to answer this in the comments below. If NIO successfully holds $6 as support after the short squeeze triggers, do you believe the ES9 launch on April 9th is enough of a standalone catalyst to push the stock toward that $18 intrinsic value within 12 months? Or does that require a broader sector rotation back into Chinese EV stocks? Drop your take below. I read every single comment, and I will personally reply to the most insightful analysis. If this breakdown gave you value today, hit that like button and help this video to rank in Hype Leaderboard. It takes 2 seconds, but it makes a massive difference in getting this research in front of more investors. And if you are not subscribed yet, what are you waiting for? Smart stock. Sam drops institutional-grade breakdowns like this every single week. Subscribe, turn on notifications, and let's build wealth together. I'll see you in the next one.